right. Thank you very much, Heather. I'm going to start sharing my screen right away, and then I'll give a little bit of a overview of what's going on here. So I'll be discussing the commodity markets today. On Monday and Tuesday this week, I attended the Midwest Extension Outlook Conference down in Kansas City, and I got a broad overview of everything: corn, soybeans, sorghum, all the way to live cattle and lean hogs and chicken and eggs and everything in between. Even cotton and palm oil, I think, was brought up at some point. So that's what I'm going to do: provide a broad, sweeping overview of all the commodities, with a little bit of a spin on the key issues to look at for our region here in the Upper Great Plains. And then I'll sprinkle in some other stuff as we go along. So broad sweeping overview of the commodity markets. If you've got questions, comments as we're going along, throw them in the chat. And if they're, if I need to stop, I sure can. And we'll just start going from there. So the commodity markets. And there we go. So this isn't a commodity market, but this sets the stage for the commodity markets. This is a slightly dated look at farm income and household spending and capital spending at the farm side. Big picture, the macro economy is in pretty good shape yet. We've got strong GDP growth, or the economy continues to grow. We've got low unemployment, and inflation has moderated somewhat, shall we say. That means the overall economy is in good shape. The ag sector is in pretty good shape. Farm income has been fairly stable, not quite as high. The expectation nationally isn't to have quite as high of income as the last couple of years, but still a good level of farm income. Nationally, the current ratio. So the operating situation is in fairly good shape for a lot of farmers. Strong balance sheet. Farm assets continue to remain steady to high, and debt seems to be moderated or held in check for the most part. So a lot of good things happening. One thing that continues to come up is input prices being high, and we see that. So a two-pronged reason to include a look at interest rates. Someone have a question out there? Or just tuned in, you could probably mute your mics. It's just the nature of the way this Zoom session is set up. Thank you. So we've got interest rates relevant for two reasons. One, it's what the Federal Reserve is trying to do to slow down the economy and rein in inflation. So they've increased short-term interest rates, and that carries over and increases an important operating cost that really hasn't been much of a factor until the last 6 to 12 months. So we can see that at the farm level, interest rates on both operating and real estate loans had been running around or just over 8% for operating loans, and that's probably going to continue. Slight uptick as we go forward, and we're probably not done seeing the effects of higher interest rates. My opinion is we haven't seen those fully come through the overall economy, and it really hasn't had a direct impact that's been felt yet on the ag sector. It's just going to take a little more time for that next round of financing to come into place, where you really start to see the impact of the higher rates. And one last thing that's not exactly a commodity, but very related to commodities, that was discussed at our conference was the fact that the 2023 Farm Bill needs to be, something needs to happen with the Farm Bill by the end of the fiscal year, or by the end of, I believe, September 30th. The farm bills in recent years have been highly dominated by very high nutrition spending, which is sort of odd, but the nutrition spending swamps the any spending on commodity or other ag, other chapters or sections in the Farm Bill. In the last few years, there's been a growth in ad hoc payments again, which different farm bills have tried to move away from over time. On the conservation side, there has been a trend towards more working lands. So CRP type programs that emphasize working lands a little bit more than otherwise. And those were just big picture things that were talked about. But the regardless of whether the farm bill gets passed or not, something will have to happen again by the end of the fiscal year. And one of the things that would come into play, whether or not a new farm bill is adopted or we have a continuing resolution of the current farm bill, there'll probably have to be a choice made by producers between ARC and PLC in terms of the price supports and such. Those have sort of flip-flopped as the price outlook and price trends have happened throughout the duration of the current farm bill, and the election will probably have to be made for the new fiscal year going forward. So regardless of what happens, there's probably an ARC PLC choice to be made for producers out there. And then there was sort of a consensus that some of the dairy situation with some of the dairy prices right now, that might be a sort of a pressure point that might result in some movement sooner rather than later on the 23 Farm Bill. Now on to something else. Again, setting the stage for this directly sets the stage for the crops, but also I would say for the forage situation and the implication for livestock and cattle in particular. Here's a snapshot of the recent drought monitor. I'm going to fetch a little bit of a laser pointer here. I'll just highlight Wyoming and Western South Dakota, for example. This area has seen pretty good improvement relative to a year ago in the broader area and a big cow-calf area. So sort of the consensus of participants was, hey, that's good news, and maybe we could see some cattle expansion happening in the greater western United States. And then we got some pockets like here across eastern Nebraska and southern Texas that are sort of tough situations right now. And this greater the I states and a little bit of Missouri as well. A little bit of mixed situation there, but especially in Illinois, Indiana, and Iowa to some extent. They're showing up on the drought monitor, but they have had decent timely rains. So that's been that's behind the scenes, or the drought monitor is not totally picking that up. And then there's a lot of variability across the Corn Belt that carries over to the corn production, and we'll see it in some of the other pictures going forward. But for the most part, the major row crops less affected, and this bigger area here was sort of giving life or thoughts to some cattle expansion. Got to get rid of this pointer. Specific to corn, oh, and one last thing on the map was a little bit of talk of El Nino continuing to come in. With corn, I just started with a South Dakota corn production. The crop acres and yield and such and production were released in last Friday's August crop production report. South Dakota's yield at 145 would be well below a trend yield of closer to 155. So South Dakota's corn in terms of bushels, not as good as trend. At the same time, it is looking like, or the preliminary estimate was almost 800 million bushels, which would be a fairly large corn crop for South Dakota. But again, we had a lot of acres behind the production, and I would not be surprised to see some fluctuation in that, since it's an early August estimate in terms of what would come out of that. But just throwing that out there in terms of production, bringing it back also, we're staying with South Dakota. Here's just the 5-year average basis. So that's not prediction of basis for this fall, but that would be over the last 5 years. If we were taking the last 5 years and saying the average basis be about 40 under December corn futures for South Dakota as a whole. And I bring this up for just a couple of reasons. One, the U.S. crop numbers are one thing, but something that dominated the discussion for corn and soybeans were the larger global production levels, especially coming out of South America. And there was talk of China perhaps being a potential source of demand for corn. So would South Dakota, for example, compete against corn supplies coming out of Brazil? If it was headed to China, perhaps that would be the case. There'd be some more demand from the Western Corn Belt. There's trouble with shipments moving through the Panama Canal right now. So perhaps if there was some uptick in corn demand from China, you could see a little better basis level in South Dakota. At the same time, if we have a little bigger crop, that would put some downward pressure or a widening out of basis. So a couple things to think about at the local level. Jumping out or broadening this out to the national picture, if we look at the U.S. corn price versus the stocks to use ratio, it's just a way to get a big snapshot of what the market looks like. When there's high stocks relative to use, you tend to have very low prices. I've got 3 price series on here. I know it's a little confusing, but I like to include some ancient history when we used to have $1.50 to $2 corn. That was all the years prior to 2007. So that's all these blue dots down here on the bottom. And then I've got 2 lines running through. One's running through those orange squares. That's the last 20 some years of price history at the national level relative to stocks to use. So when stocks have been very tight, like they've been in the last few years, we're looking at that left-hand line going through there, and that's showing where prices are at the different stocks to use levels. And currently with the old crop, the 22-23 crop year, we've been hovering up here in this top little square. Jumping ahead to the current situation, if we talk about new crop corn, December 23 corn, or the 23 crop that will be marketed throughout this October, November through next year, that marketing year average price from the WASDE is currently sitting there at $4.90 a bushel. And that reflects an expected stocks to use ratio or ending stocks to use ratio, again, straight from the WASDE, of 15.3. And I'll point out 2 things with that. Get the laser back in here. If we just look at where this is and where this particular projected observation is, you can see that it's up and it's in this direction relative to our recent history. It's also to the extreme of where price and stocks to use ratios would come from the baseline estimates. So for whatever reason, the modeling and such that they're using is giving a price that's higher than you might otherwise expect relative to that level of stocks to use. Now, some of that can be just carryover from this current situation being higher than where the modeling would suggest you might see prices. So that's one aspect. The other aspect for corn is sort of the consensus, or a lot of the talk was that the latest WASDE really reflects very high levels of exports. And with the current price level for U.S. corn relative to many of the competitors, U.S. corn seems to be expensive or seems to be priced out of the export market. So the question was, how can we have exports stay high if U.S. price remains very high relative to the world price? So something's got to give was sort of the consensus. If exports would not stay at the very high levels reflected in the latest WASDE, you could take 1, 2, 3, 400 million bushels off the export number, and that would greatly increase the decrease rather the use level and increase the ending stocks. That would move this to a higher stocks to use level, and regardless of any carryover from this last year, probably put more downward pressure on price going forward. So the export uncertainty is probably the biggest source of uncertainty right now when we talk about the 23-24 crop year. That's the corn situation. Soybeans, again, circling back to South Dakota in particular. A lot of talk about soybeans being a follower crop this year. Producers across the country tried to get the corn in first, followed it up with soybeans. South Dakota, the production estimate from last week, right in line really with some of the earlier estimates. And the world has been producing a fair amount of not necessarily soybeans, but oil seeds in general. So global oil seed production has really ramped up in the last year, especially out of Brazil. So there's a lot of competition out there. So South Dakota's production, not a modest production level by any means, an increase from last year, but still not back at the levels we saw, say in 2018, 2016, even though we've got a fairly large acreage level in the state. And again, yields are expected at in the report, we're at 42, which would be a little below trend line as well. The situation at the national level is a little different compared to corn. So I've just thrown the price and stocks to use ratio out there. So that current projection for 23-24 is 1270 a bushel. With a continued tight ending stocks to use ratio, that sub 6 stocks to use ratio. So crops bigger than last year, but it's not going to be big enough to alleviate the demand pressure on soybeans, was the general consensus. And 23 relative to the 22-23, so new crop versus old crop, actually tighten the ending stock situation, but the price still falls. So a lot of that is carryover from corn, but it's also reflecting that increased global production. There was a lot of talk already. So we haven't even harvested 23 crops. But there's a lot of talk already about looking at or thinking about the soybean to corn ratio for 2024. So take new crop soybeans divided by new crop corn and compare that to recent history. The consensus is that with soybeans remaining relatively high, you're going to have some legitimate price pressure saying we need more beans, we need more beans. So that'll be something to already start watching for the 2024 crop. And there's also talk sort of behind the scenes, much like, or because you put a bunch of ag economists in the room, if the economy is having a little bit of a soft landing, the same terminology was applied to soybeans. We haven't had a huge increase in production, and the price of soybeans is expected to remain a little bit better. So we're not having quite the extreme increase in soybean production to push down price dramatically like has happened in some of the recent years. So perhaps a soft landing in terms of the soybean price picture. Another thing with soybeans that sort of dominated a lot of the discussion was the general push in the oil seeds for renewable diesel and the addition of several possible crushing plants. Various oil seed crushing plants were discussed. Here's a slightly dated map now of some of the soybean crushing plants proposed, both in all the way from the Gulf of Mexico up to northern North Dakota. So that was also discussed, and that's been behind. I'll just jump to the next chart, behind a fairly dramatic increase or shift in terms of the relative prices and relative values, especially over the last couple of years, of soybean oil versus soybean meal, or all vegetable oils versus the meals, or oilseed oils versus meal. So here's a recent snapshot from earlier this week of the December futures prices of soybean oil and overlaid with soybean meal. So the high lows going across here on the top are the soybean oil prices. So soybean oil, I used to think of 20 cents a pound, and here we are at 63 cents. And soybean meal, $380 a ton on the board or on the futures market at this time. So that continued shift or demand for the various oils, oilseed oils, to be refined into renewable diesel continues to dominate this market, and has brought on or continues to bring interest from processors looking to convert oil into diesel. Now, with more oil being produced, you're seeing, or more demand for oil in the US, you're seeing more crushing in the US. More crushing in the US means more soybean meal in particular available in the US, which would have some downward pressure on some of the smaller livestock inventories, but some downward pressure on the protein feed prices, and then also adds to the supply. So you're looking now, instead of what used to be, we're going to export soybeans, now we're exporting meal. The European Union has been thrown out as a good market for continued or sustained soybean meal exports. And then Vietnam was thrown out as a potential market that would perhaps be able to absorb, or would be willing to take on a fair amount of oilseed meal if the U.S. were to increase production. Continuing on, so just like the United States is looking at crushing more soybeans, north of the border in Canada, there was talk of them expanding canola production and also canola crushing. So they would be trying to supply the diesel or biodiesel raw material to the West Coast market, just like North Dakota is trying to do. So canola, I just grabbed a canola futures price. It was talked about a little bit. I believe this is in Canadian dollars. So if you're looking to cross hedge or something, you'd need to take that into account. I'll be taxing my students with such a thing, hopefully starting next week when we have a commodity trading class downstairs here in Harding Hall. But that would, that higher canola value over time, does reflect the fact that the canola is higher in oil as a percentage of the raw feedstuffs there. And I threw sunflowers up there too, because that was also discussed as just another potential crop that is a little bit higher, or is higher in oil as a percent. And that would also be something you could look at, perhaps compare it to canola, but also think about its value, its relative value of meal and oil. On to wheat. A couple things with wheat, starting with just the August crop production report here, and I took this directly from NASS, but sort of the consensus was all the analysts missed the mark with the actual NASS number coming in here well below, right down here, well below some of all the industry or trade expectations. At the same time, if we look at the futures price, new crop Minneapolis exchange wheat really didn't respond at all to any of the surprise news or surprise aspects from the report. The prices have trended down following the winter wheat harvest that we've seen. So with the winter wheat, sort of a highlight from that, a couple things going on. South Dakota's winter wheat not so good in terms of production or yield here. So we've got yields and percent change from a year ago. A lot of talk about what I think of as like the Eastern Corn Belt. This area here, a lot of record high yields in Ohio. You got Ohio, Indiana, Kentucky, record high yields, surprisingly high yields, or the producers, growers were surprised when they got out and got their wagons filled. It's like, okay, that was a lot of wheat out of that field. So that unexpected and happy producers to have a lot of bushels, but that's all soft winter wheat, and that's all weighing on Chicago, for example, Chicago wheat prices, and that's carried over to the hard red winter wheat, and also to some extent put some downward pressure probably on that new crop spring wheat price as well. So wheat's been under a little bit of price pressure from good production of those other wheats. What does that leave in terms of maybe a decision or something to be done? Maybe some potential for some rallies yet with the spring wheat market. Ample wheat out there, but perhaps to do some blending or mix it in with a bigger winter wheat crop to have to move through or go through. I think that was it for the last bit of pieces for the crop side of things. As we discussed various crop prices at different times, and corn's very expensive. Everybody from cattle producers to some of the feed companies and such looking for, is there a substitute? So what we've done is went back and shout out to Madison Henley, who's working for the Nest School with this helping us this summer and into the fall. She put some of these updated factors together, just went back the last few years, compared the price of barley, sorghum, oats, millet, and rye relative to the price of corn to get a relative price factor. So on barley, she's calculated out that, hey, a working idea for a feed barley price would be 97% of the price of corn. So here's an example. If we use $4.21 corn, that would imply $4.10 a bushel for barley. Sorghum and millet are in there as well. Those were discussed too as crops with some potential if there'd be any kind of disruption supplying corn to Mexico. Those would be alternative crops that would possibly supply that market. Oats has its own futures market, but that's a fairly thinly traded market, so it's maybe not as reliable to use for planning purposes. And then we did some things. We tried some different stuff. Madison had to try some different stuff with rye. She benchmarked it against corn. It's at a premium to corn, but it's at a slight premium to both spring and winter wheat as well. But that's using a national price. We didn't have a local price available. So just some other price factors. And for sunflowers, for example, we also try to benchmark that against finding its value in terms of the relative portions of meal and oil, and benchmarking that against soybean meal and soybean oil. I'm just going to pause for a second there. Heather, is sound and everything okay? And I haven't checked the chat. Any questions out there on the crops?
Everything's going well. No questions that have been typed in.
Okay, so I'm just going to keep rolling then. If there's questions, please put them in the chat or shout out, and we'll just pause. But that's the crop side. We'll shift over to the livestock now. Whoops, one last sort of transition. This is a crop, but it's a feedstock. The U.S. hay supply. This is not NASA's. I updated this chart from the Livestock Market Information Center just to reflect the current the crop production report numbers from last Friday. So we can see that at the US level, with the increased production, we're seeing an increase in the hay supply, and with slightly smaller livestock numbers, that would suggest the demand would be a little bit lower, and better pasture conditions around the country. That would also take some of the supply pressure off. So fall disappearance will be a bigger factor nationally, but perhaps a little less pressure on hay prices. The same with South Dakota. Slight adjustment revision. The alfalfa number was up relative to maybe what we'd have expected, and the other hay yield a little bit lower, but production a little bit better than last year. Numbers probably steady, a little bit lower, so a little bit less demand for hay locally as well. My observation, driving a lot of interstate north and south here in the last couple of weeks, a fair amount of hay is coming from the north headed south. I didn't see anything go in the other direction this in recent weeks. On the beef side, something that's perhaps a factor, I guess, to watch is retail prices. So the retail price of beef here, this top, the top line, retail prices continue to stay high or move higher, and that's okay with price inflation and everything else, fine. But relative to the other meats, especially pork, beef prices are getting higher and higher, and pork prices are moving lower and lower. Well, at some point, you could have consumers shifting from beef to pork. Some people might argue with that ever happening, but if there is consumption shift because of price, that pork's looking relatively expensive or relatively inexpensive compared to beef. Poultry has also come down in price, especially for different pieces. We'll look at that a little bit more, but pork seems to be having trouble finding its way in there in the middle. But certainly a risk is if beef gets too expensive to start hurting consumption, that could put some downward pressure on cattle prices from very, 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 very high levels that we're seeing right now. Cattle inventories. This is just a cattle cycle type chart showing, hey, what's the range of things that could happen, further contraction or some turnaround and uptick in numbers. And sort of the consensus of the group was we're really not set up to do any major expansion this year, so maybe next year. And so you might first see total cattle inventories turn around January of 2025. So really kind of just said, hey, this is looking like we're pushing any cattle expansion further down into the future. Gonna check notes here with the with cattle in general right now, especially on fats. The implied volatility is pretty low, a little bit skewed in terms of a little higher volatility at the lower strike prices. So think going out and buying livestock risk protection or put option protection on fat cattle. There you've got more concern, a little bit more downward price movement might be possible compared to further upward price movement. So it's starting to be reflected in the in that volatility pattern. For feeder cattle, the main thing talked about there, continued, here's July 1 look, continued tight feeder cattle supplies outside of feedlots. The big thing was with the high current feed prices, not necessarily high expected feed prices, but the high current feed prices, big incentives to add pounds to animals at lighter weights. So several people were talking about the feeding margin for backgrounding or stocker level operations, different ways and big values to be captured, putting weight on before the animals get to the final heavy corn intensive growing phase in the feedlot. So a lot of producers from around the country and extension economists from around the country, that was sort of the talk, is really put a pencil to where you can most effectively put gain on cattle in particular at the different weights because of the high spreads and high returns to feeding at the moment. On the heifer side of things, so here again is the July 1 snapshot of heifers. Very few heifers being held for replacements as of July 1. The beef cow culling rate has slowed a little bit. These numbers are down, and partly looking at the drought monitor, sort of folks were asking, will there be expansion? Is it possible to see expansion again in the Western United States? And who will supply replacement heifers to the Western United States? And it was sort of, my observation was we still have very tight hay supply situation. So if that holds back expansion, that would be a factor. But perhaps if you have the feed and you have the wherewithal, at some point it's too late to develop replacement heifers to try to supply that market. So it would come down to timing. Is that this year? That's something to at least kick around or think about a little bit, is supplying the replacement market further west. Another meat that we didn't talk about a lot at the conference, but it was sort of brought up on the side here and there. Everything from lamb, also goat prices and such. So I grabbed slaughter lambs here, and you can see the price spike that occurred over the last couple of years. It stopped about last, say, May and June, and then prices fell. And recently they've spiked up a little bit again for slaughter lambs out of Sioux Falls, but the same pattern's happening in several of the weight classes and such, and some of the goat prices is also. So you've got some downward pressure again from some of the competing meats, but again, it might be just another interesting commodity that we don't follow all the time, but there is some information out there on it. Hogs, again, relevant for several reasons. There's hog production in South Dakota. This is out of Iowa. Some of the losses were record high losses. So here it is out of Iowa. So a string of month after month after month of losses in terms of loss per head for a full farrow to finish operation. Feed costs are primarily behind this. So the hog price is still relatively high, but feed costs just hurt the profitability. So feed costs are driving these losses. One thing that in Iowa especially is they're calculating out the manure credit. They figure the manure credit is worth about $8 a head. So you're continue to finish hogs for the manure to a certain extent. So that was another just something I hadn't thought about. So I thought it might be interesting to folks here too. The sows farrowing. So here's the most recent snapshot of sows farrowed. Looking back at the last or most recent, the June hogs and pigs report, the pig crop was higher than expectations. So there's more pigs coming than was expected. And then the farrowings were much, much lower than expectations. And sort of the consensus was that, actually it wasn't consensus. I'll give Lee Schultz at Iowa State brought this out. He's like, this isn't working right, or something's not consistent, internally consistent with these numbers. The sow slaughter isn't matching up to suggest that farrowings have backed off quite as much as the most recent hog and pig numbers. So going forward for the next two immediate quarters, both the farrowing numbers or farrowing intention numbers from the report were right around 2.95 million head for both the June through August and September through November numbers. So, that would suggest this farrowing level just sort of flatlining out here, not having all these cyclical spikes and such, and certainly nothing like the 3.2 million head farrowed back here. But that it's not consistent with a huge increase or sustained increase in sow slaughter or something to suggest that the numbers to be farrowed won't be there. So Lee's sort of end of the day take was one of these two things is off. Either we need to see slaughter go up, or we need or expect to see an adjustment or a revision, and we're going to have more farrowings in the next 6 months. So again, bringing more pork to the market would be putting additional pressure on beef prices in particular. Weights on the hogs have come down, and a little bit of disparity between open market hogs and some of the packer owned hogs, but nonetheless lower weights moving the product faster, pulling some of the hogs forward. On the milk side of things, shifting gears a lot here. The milk price ratio, a lot of talk about the high alfalfa and forage prices, and looking backwards, high corn price would feed into this too. You've got high feed prices, and as milk prices have fallen, that's really squeezing things in terms of profitability on the dairy side. And as far as components and such, butter was the only sort of bright spot discussed as butter holding its value relative to the 5-year average. Prices are still lower than last year, but it's holding its value a little bit. I'd say the non-fat dry milk was the powder was kind of holding in there as well. Cheese prices have been under a lot of pressure, and that's pulling down or directly pulling down milk prices. As far as some of the other on the poultry side of things, the fair amount of talk about high prices last year actually resulted in imports of chicken breasts and some poultry cuts, and that eventually led to some downward pressure on price, especially as U.S. production came back. The poultry hasn't been featured as much by retailers, and as a result, we've got an increase in a fairly large level of chicken in cold storage right now. So if you shake a cooler, you might have some chicken breasts fall out of there, and it's just it's a sector that's weighing on prices and profitability in general. But at the same time, the good news is you're able to ramp production up, and higher numbers would give you a little better consumption of corn and soybean meal moving forward. The other type of meat like that discussed was turkey. So here's just a sort of the dramatic shift in turkey breast prices. So at those high levels seen throughout the latter part of 2022 into the beginning of 23, really priced turkey out of the market and made it relatively unprofitable to feature, say, in a restaurant sandwich or something at those prices, especially when you compare those extremes relative to, say, the 5-year average line down there on the bottom. So it was all more like $2 a pound instead of $6-7 a pound. So that's sort of the consensus was that turkey was maybe sort of an unloved meat in general, and certainly at those the high prices seen last year. The last ag related commodity, egg production has come back up, both in terms of eggs for the table market, but also eggs in the layer side of things. And that's given some downward pressure, certainly on on prices. So here's a snapshot. So this was last week's large weighted average price, national level, a little higher in California, the California market, but the recent price, $1.20 a dozen at the wholesale level. So that's not a retail, but a wholesale price. Certainly much better than where prices have been over the preceding 12 months. The carryover to that, more affordable eggs has helped the demand for pork bellies and bacon in particular. So you're seeing an uptick in bacon consumption because you can afford a plate of eggs and bacon again, was sort of the running consensus of that. So I know that's a laundry list of commodities and things, but it's just a snapshot of what we've been going through. Here's my contact information just to finish the story. You can always email me or try the old office line. And then here's our required regs here too. And that's it.